Hello everybody, thank you for watching this video. In this video, we'll be going over cost management and cost volume profit, or CVP. After this class, you should be able to define and give examples of the major cost groups that a restaurant or a food service business would have. You're going to be able to allocate indirect costs to operating departments. You're going to use relevant costs and distinguish them from non-relevant costs to be able to make decisions. You're going to use variable costs and fixed costs to make decisions about, possibly what kind of business we should be buying, or if we should be closing down during slow periods. We're going to be able to define operational leverage and understand its advantages and disadvantages in different contexts. And then we're going to also be able to use 3 different tools to separate total and semi-variable costs. After we do some of those things, we're going to be segueing into cost volume profit, where we're going to be talking primarily about the different methods of calculating break-even, or conducting a break-even analysis. So I just wanted to give a bit of an overview to cost management. Okay, typically cost management is understood in controlling costs, allocating them, budgeting for them, and making sure that we have sufficient resources to cover our costs. In our lecture here today, we're going to focus primarily on using cost and really understanding the relationship of costs with respect to our sales and profit in order to make some decisions. We will allocate costs to different operating departments, but I think it's more valuable to you to understand the nature of your costs in various contexts in order to make important industry decisions. And we really rely on the relationship that costs have with our sales and our profit, because our profit, as I have here, is equal to our sales minus our expenses. So if we don't manage our expenses or costs properly, then our profit can be negatively affected, and that's what we don't want. So today I'm going to be showing you how to manage your costs in several contexts and ways in order to make good profit forward decisions. One typical response in industry that I'm used to dealing with is cutting labor costs. I mean, if you're in industry, you've probably heard the labor word already. Management is super focused on labor because it is a controllable cost, but also because it's a very large cost. And it's really funny because I've always been of the opinion that in times of sales going down, you shouldn't be cutting labor. You should be putting more labor on, right? Because if sales are going down and you're cutting labor, that means there's less people on the line, there's less servers in the dining room. That can possibly lead to issues in service or in the food, whereby customers don't come back. Okay, but all of these costs are manageable costs, and that's why it's important to be able to understand cost management and apply it properly, so that we can guard against potential issues with our profit going down. Here's a bunch of different types of costs or cost categories that businesses or food service businesses would have. The first here is, and they're just definitions. I'm sure you're fairly familiar with most of these. Some will be new, but most won't be. Fixed costs are those costs that do not change with different sales levels. Like your sales can go up or down. Your fixed costs are going to stay the same, right? So an example of this, most frequently cited, is rent. Even on a personal finance example, your rent is not going up and down depending on how many days you sleep in your house, right? So that would be an example of a fixed cost. Okay. On the other hand, or almost opposite to fixed costs, we have variable costs. These are those costs that change with different sales levels, right? So the big ones in our industry are food cost, beverage cost, labor cost, things like that, and they're all variable because those costs go up the more we serve guests. Okay, in most cases, these costs should also go down, but the only way they can go down is if we manage them. right? For example, your labor cost. If you scheduled five cooks to be on the line on Monday, and you're expecting sales to be $1,000 on Monday, and it turns out to be a slow evening, that variable cost won't go down unless you call off people or ask people if they want to go home early, whereby getting that cost down. Okay, so it is variable. However, we do have to do some managing to get those costs down when the sales levels aren't there. Semi-variable costs are costs that have both a fixed and variable component. Okay. An example that you might be familiar with would be your cell phone bill. Okay. So for $100 a month, you have a certain amount of text messages and data. Okay. And let's say that's $100 a month. If you use all of that data, you're charged by usage, right? So it turns it into, instead of a fixed cost, which is $100, the cost goes up based on your usage of it, past that threshold. Okay, so it's a combination of both a fixed and a variable component. In our industry, I think the only semi-variable cost that we would have would be total labor. Total labor is a combination of your hourly wages and your salaries. On income statements, it can be the line item or the account can be salaries and wages, or it can be simply total labor. Okay. In some cases, they do separate it. If they don't, or it isn't separated on an income statement, to truly understand what the fixed and variable component are, or what the fixed and variable components are to this semi-variable cost, we have to manually separate them, which we show you today. We have direct costs, which are costs that can be directly allocated to the operating department that created them. Okay, for example, that's why when we're calculating our food cost percentage, we calculate our food cost. We calculate it by dividing our food cost by our food sales, because we can directly allocate that cost to that revenue line. Okay. Same with our beverage cost. All other costs, for the most part, in food service are all indirect costs. Okay, and an indirect cost is incurred or generated for the overall benefit of the organization, and cannot be allocated very easily, right? I think we'll agree that, yeah, back of house labor can be to some degree allocated to food sales, but at the same, you can't do the same thing with front of house staff, right, or front of house labor, because front of house labor runs the food, runs drinks, makes the drinks, serves guests, things like that. Or even like the wage for a host, like you can't allocate that very easily. So this is an indirect cost, and generally it's been incurred for the overall use of the business. Same as rent, you know what I mean? Rent is a fixed cost, but it's also indirect because we cannot allocate it to one operating department over the other, because both the front of the house and back of house, if we think of those as two operating departments, both use the building, right? So it can't be allocated very easily. And we'll show you how to in some cases, allocate those indirect costs today. We also have controllable costs, which can be influenced or changed by management in the short term. Okay, most variable costs are good examples of controllable costs because we can change them, right? For example, I can change how many people I have on the line. I can change to some degree the cost of my food and the cost of the beverage. Well, maybe not the beverage. To some degree, the beverages, yes. So these are all examples of controllable costs because I can influence them and change them within the short term. On the other hand, we have non-controllable costs, and these are costs that cannot be influenced by management within the short term. Okay, and most fixed costs tend to be examples of non-controllable costs, because I can't really control, I can't control my rent. Okay, it is what it is, right? It's outside the scope of my influence, and things like that. So here are some initial cost categories with some examples. In the next slide, I'm going to go over some more as well. All right, types of costs continued. First, we have joint costs. This is very similar to indirect costs, and these are costs that are shared by two or more operating departments. Okay, because this cost is shared by two to three or two or more operating departments. It's hard to allocate, and it's indirect because that cost is being incurred for the overall usage of those departments. Okay. Um, we have discretionary costs, which are costs that may or may not occur based on the decision of a manager. Okay. Um, yeah, this could be what would be an example here? A renovation would be a discretionary cost, right? And it doesn't necessarily affect sales. A pizza party, having a pizza party for your staff, or whatever kind of party, that's a discretionary cost. We also have relevant costs, and these are costs that are relevant to a particular decision. Okay, and they're relevant in a particular decision because they differ from another alternative, which I will give an example in a second when I go through that particular part of the lecture. But just as a quick example, if you're deciding between two pieces of equipment, you want to buy a piece of equipment and you've got two options. If the price for equipment A is 100 and the price for equipment B is 600, because those two prices differ in the same decision, those costs are relevant. Okay, we'll go more into that later on. We also have sunk costs, and these are costs that will be incurred, okay, but nothing can be done about, okay, and as such, they're typically non-relevant, so we do not use these in making decisions, okay. A lot of losses are examples of sunk costs, and what you'll find is that if you use sunk costs in making decisions about you know um, to repair a piece of equipment versus buy a new piece of equipment, it could lead you to a financially irresponsible decision. Okay, so we really need to understand the difference between the two, and I'll show you through an example how we can make a differentiation. Okay, and then lastly, probably the most complicated to explain. I'm quite sure you've heard this term in economics already. It's opportunity costs. Um, I prefer to give a very brief definition to this type of cost. It's very simply the cost of not doing something, or the cost of picking one alternative over another. Okay. Um, I have two examples lined up, and they're fairly straightforward. So I hope to be able to explain that in a way that is different from the economic definition that is, I think it's primarily based on utility. Well, I think the definition is it's the utility lost from choosing one alternative over the other, which is kind of funky. I'm sure they get more complex, but anyway, so here are a lot of the costs that we're going to be talking about today. And we're going to be analyzing how they can be used to make different decisions. So using opportunity costs to make decision, right? If we understand that any decision has to have a net benefit to it, right? So there's a benefit to making a decision. Okay, there's a cost to making a decision. If you take the benefit, subtract the cost, and there's a positive number, if there's a positive difference, that means there's a net benefit. Okay, in a lot of cases, we need to use opportunity costs in order to make a decision between two particular alternatives or courses of action. Okay, for example, let's say you've got $150,000 spare cash in your business. You're deciding how it should be used. You have two options. One, you can invest it at 3% annually. So you're going to invest $150,000 at a 3% interest rate, and you're going to make interest off of it. Or you can make a lump sum on on your $150,000 loan that has an annual interest rate of 4%. Okay. Now immediately here, this is not a terribly difficult example. If you look at the principles are the same, so 150,000. The interest rates are different, right? So 3% and 4%. Obviously, making a lump sum on your loan, just based on this information, is would appear beneficial, right? Because you're saving more money than you'd be making. Okay, but this does not take into consideration the opportunity costs, which I'm going to show you using a table on the next slide. Okay, so here's where I've kind of tableized the two particular options that were continuing from the previous slide. We have option A, which is invest, and then B was pay down debt. We're taking in option A, we're taking 150 grand, investing at 3%, and the annual interest on that, or the annual benefit, would be $4,500. Okay, so just let me have a marker here. There we go. Would be 4,500 bucks. Okay, that's 150,000 multiplied by 0.03. Okay, and that gives us the interest. Option B, on the other hand, if we were to pay down debt, let's say we make a lump sum on our loan of 150 grand, and we completely wipe it out. That means we'll be saving the interest every year after that, right? So $150,000 multiplied by 0.04 gives us a savings of $6,000, right? Now, that's the benefit for each particular option. Okay, now we have to take into consideration the opportunity costing. And keep in mind, this is a fairly simple example. I go into a bit more of a complex one after this. But if we understand that the opportunity cost associated with each option is basically not getting the benefit of the other. Okay, so for example, option A, the opportunity cost for option A is not getting the $6,000 from option B. Okay, the opportunity cost for option B, or paying down the debt, is not getting the benefit of the investment income from option A. Okay, when you take the benefit, subtract the opportunity cost, you get the gain or loss. Okay, so for option A, we have a loss when taking into consideration the opportunity cost, or a net loss. On the other hand, option B, we have a positive difference of plus 1,500, and this is called a net benefit. Because option B has a positive and higher net benefit, we would pick option B. Okay. Again, this was a fairly simple example. The next one gets a little bit more tricky, but again, it shows how we can use opportunity cost to make decisions, even in different contexts. All right, so here's the classic example that every single economics professor will ever give you. So you're deciding if you should go to college, and you got two options. Okay, you go to college, you don't go to college. Okay, if you go to college, you're going to spend 40 grand over the next 5 years. Okay, but you hope to get a little bit of a return off that, in that you're going to make 60 grand. Let's just call it 60 grand for the rest of your 60 grand a year for the rest of your career, which is we'll call it 40 years. Okay, so the benefit here is the 60 grand per year multiplied by 40 years. Okay, and then we subtract the initial 40 grand that you're going to pay in tuition. Okay, if I put that into my calculator, just going to do this real quick. 60,000 multiplied by 40. There we go, minus 40,000. We get $2,360,000 as an overall benefit for this particular option. Okay. However, okay, you have another option. Okay, instead of going to college, you can start work now and make 50 grand for the next 45 years, because you're not going to be going to college. Okay, and instead of spending that 40 grand on tuition, you can invest that $40,000 now at 5% interest. Okay, and you know what I mean, we'll call that your retirement retirement fund. Okay, so the benefit to this is fairly straightforward as well. Okay, so it's 50 grand multiplied by 45 years, not 40 because 45 because we're not in college. Okay, plus 40,000 multiplied by 0.05 multiplied by 45 years. Okay, you add that together. Just let me see what this is. 50,000 times 45 years. That's 2,250,000 plus 40,000 multiplied by 0.05 gives us 2 grand. Multiplied by 45 years is 90. Okay, so 90,000. There we go. If we do the addition quick, we get 1, 2, 3. Okay, we get 2,340,000. Okay, so that's our benefit, our initial benefit for each option. Okay, now this does not take into consideration the opportunity costs. For example, in the first example, for the first option, by choosing that option, we don't get the 5% interest on our the $40,000 for 45 years, and we're also losing the $50,000 for the 5 years that you could have been working. Alternatively, for option 2, the opportunity cost is the difference in the earnings. So what's that about? That's 10 grand. Okay, the difference between 60,000 and 50,000 is $10,000. The opportunity cost here is the $10,000 per year multiplied by 45 years. Okay, so in the next slide, again, I've tabularized the opportunity cost, and I'll show you which option we should be picking based on the highest net value. All right, so here's I've tabularized the results. Okay, so again, here's the benefit from going to college and making 60 grand a year. Okay, but having to pay 40 grand, and here's the benefit to working for 45 years, not 40, and making $50,000 a year and investing the initial $40,000 at a 5% interest rate to save for your retirement. The opportunity cost with each. Okay, so the opportunity cost for going to college and not working right away stems from the so this is option 1, no investment, no 45-year interest. Okay, so you're not getting that, so that's going to be calculated into the opportunity cost, which is again $40,000 multiplied by 0.05 multiplied by 45 years. Okay, the other opportunity cost is that you're missing the 5 years that you're going to be in college. You won't be able to work, right? So you're missing 5 years worth of work. Okay. So if you take the $50,000, multiply it by 5, and then add the interest income, that gives you your opportunity cost. Opportunity cost for going to college instead of working straight away. On the other hand, we've got option number 2. Okay, option number 2, the opportunity cost is that you're not making the extra $10,000 per year for the next 45 years. Okay, so again, you do the math: 10,000 multiplied by 45 years, or sorry, 40 years, because you get 400 grand. Okay, so if you do the math, the benefit minus the opportunity cost, you get the net gains or the net losses. In this case, it shows that going to college is based on the opportunity cost, and the benefit has the higher net gain. Both have gains, don't get me wrong, but the going to college has the higher net gain. Okay. Now, while this was a personal finance example, you can apply this exact same logic to making different decisions, right? So it's about which what is it called? What menu items to promote on your menu? What dishes should you include on the menu? What pieces of equipment to buy? How do we spend money for the overall betterment of the restaurant? Things like that. Okay. So again, this was just the classic example of using opportunity costs, okay, in making decisions. Another important component to cost management is being able to allocate indirect costs to various operating departments. We need to do this, and these are primarily fixed costs. But doing this helps us understand how profitable each department is, and in the event that one is not profitable, what to do next. Okay, if we are to assume the most profitable absorb all of the fixed cost, then it's not quite an accurate picture of our organization, but also it may inflate the earnings of the other operating department, which is not good. So to do this, okay, we use sales mix percentages to distribute indirect costs to each operating department dependent on the proportion of sales that they generate. Okay, the rationale here is, if revenue is produced by performing activities and behaviors and things like that, and these activities consume resources, then we should be allocating costs based on the sales activity that was produced. Okay, this is the main justification of activity-based costing. We don't go into it too much because we don't use that costing technique for most things in food service. But it's a good justification or rationale for allocating indirect costs. So I'm going to show you essentially how we do that in the next slide. Okay, so before we get to the correct use of allocating indirect costs, here's an example of it done incorrectly. Okay, this does not take into consideration the sales mix, and the indirect costs in this case are split evenly. Okay, so 24,000 divided by 12 by 2 gives us 12,000. What we're doing here is just allocating it in half, okay, to both our restaurant and our retail store. Okay, this 24,000 can represent we'll call it rent. Okay, so we rent a giant building, and half of our building is the restaurant, and the other half is the retail store for canned products, things like that, soups, sauces. So here, this says that our restaurant is making 18,000 in operating income, and our retail is making 17,250 in operating income. Okay, what this has done by allocating it like this equally, it's created a false picture of what each department's operating income is. Okay, so these are incorrect. In the next slide, I'll show you how to use the sales mix to distribute these indirect costs more effectively and accurately. All right, so here's an example of allocating these costs correctly. Okay, first we have to calculate each operating department's sales mix by taking the sales for department sales, and then dividing it by total sales. When we do that, we get a sales mix percentage of 70% for our restaurant, and for our retail, we get 30%. Okay, so that means that 30% of our total sales were generated through our retail store, and 70% of our sales came from our restaurant. What this also means is that we can allocate 70% of our fixed or indirect costs to our restaurant, and 30% of our indirect cost to our retail. Okay, how we do that is we multiply the amount of the total indirect costs by the sales mix percentage, and it will give us the allocation of the indirect costs or expenses based on that sales mix percentage. Okay. So in this case, what we've done is allocate it based on usage of it, or sales mix. And what has happened is that it's shown that our operating income for our restaurant is actually lower than our retail store. So our retail store's operating income, or profit before EBIT, is higher than the restaurant, right? So in the previous example, the restaurant's operating income was higher, right? It painted an incorrect picture of profitability between the two departments. In actuality, our retail store is the most profitable. Okay, imagine if the retail store's sales were going down a bit, and you were allocating these costs incorrectly, and it looked like the retail was actually losing money based on how we were allocating the cost. You might make a decision based on that information to close the retail store. Whereas if you had allocated it based on sales mix, it may still be making money. So you would actually lose more money by closing the retail store. So it's important to be able to allocate our indirect costs and really understand that relationship with sales to be able to more effectively manage your costs. It's important to note that all of the tables and charts and stuff within this PowerPoint video are going to be our topics of our Thursday seminar when we complete the various worksheets. Okay, so while you're looking at some information here and it's already kind of been done for you, we are actually going to do this and apply some of this knowledge on in our Thursday seminar. So just a quick little debrief from that example. If done incorrectly, allocating costs to different operating departments can yield incorrect information that you're making decisions with. Done correctly, it can more accurately paint a picture about which operating departments are more profitable and which ones need to be worked on for improved financial performance. And the general rule here, okay, as long as a department has a positive contribution or a positive operating income, do not close it down because it's still contributing towards other fixed costs. So now we're going to talk about using relevant costs to make purchasing decisions. Okay, in our example here, we're going to use equipment. Okay, so the various equipments that you could be purchasing: walk-in fridges, walk-in freezers, line equipment like cold, hot drops, things like that. In order to be making these decisions, you need to use relevant information. Okay, and as such, not consider irrelevant or non-relevant costs. If a project has similar costs or the costs are the same, these are considered to be non-relevant, sunk in a lot of cases, or sunk costs, and they should not be considered when making a financial decision. For example, if we have equipment A and we've got equipment B. Okay. An example of a relevant cost, let's say here the, what would we be here? Okay, we got depreciation. Okay, and we've got the initial cost. Okay, let's say, okay, well, I guess this is a bad example with the depreciation. Let's say instead of saying depreciation, let's do maintenance. Okay, because depreciation is based on the initial cost. Let's say equipment A cost $200. Okay, equipment B cost $400. The maintenance on equipment A is $100, and the maintenance per year on equipment B is also $100. Okay, because the maintenance for each, this is a 1, sorry. Because the maintenance cost for both pieces of equipment are the same, they're equal, this is a non-relevant cost, okay, because they're the same. So there's non-relevant to our decision. However, the initial cost of the equipment, equipment A is 200 and equipment B is 400, because those are not equal, they are considered to be relevant costs. Okay. Now, again, we don't use we don't use non-relevant costs in making decisions, only the relevant costs. So here, we wouldn't even consider, or maintenance cost wouldn't even be a consideration in making this decision, A over B, because it's simply non-relevant. Okay, and we go into a bit of a deeper dive in the next slide. So here's some information pertaining to two pieces of equipment. Okay, in this just very quick exercise, in this particular slide, we're just going to distinguish between the relevant and non-relevant costs here. Okay, and again, if there's a difference between the two, it is relevant. If there's no difference, it's not relevant. Okay, equipment A and equipment B, the cash cost or the initial cost, they're different, right? So difference between 10 and 8 grand is 2. So this would be a relevant cost. I'm going to put R for relevant and NR for non-relevant. The estimated life for both is 5 years. Because they're the same, it is non-relevant, okay, except if it was to be used in the calculation for depreciation. The residual values for each piece of equipment is different. So 1,000 versus 800. So because they're different, this is a relevant cost. The initial installation fees and training costs differ between the two pieces of equipment, so they are both relevant costs. Okay. The annual maintenance and the annual cost of forms for the next 5 years are all different. Okay, 300 versus 400 and 650 versus 750. Because they're all different, they are relevant as well. Okay, the annual wage cost, however, on the other hand, is 22,500 for each piece of equipment. Because these are equal and the same, this is again a non-relevant cost. So we use, in looking at this, the only two pieces of information we're really not using to make a decision about which piece of equipment to buy is the estimated life, okay, because it's non-relevant, as well as the annual wage cost, because, again, non-relevant. In the next slide, I show you how to compare these two alternatives using relevant costs to pick the cheapest piece of equipment. So, making a decision about which piece of equipment to buy, again, we only consider the relevant costs, and we need to calculate and compare the total cost for each alternative. Okay, it's also important to assume here that both pieces of equipment will do what we need them to do. Okay, so they both give the same utility. Okay, to do this, we don't just consider the upfront costs of a piece of equipment. We also need to consider the reoccurring costs that exist in the future. As a result of this, our total costs are equal or is equal to the initial cost of the equipment plus the reoccurring costs that are going to happen or are going to be incurred over the course of the equipment's lifetime. All right, so here's just an example of comparing the costs, the total costs for each piece of equipment. Okay, so we've got the initial costs, which is the cost of the piece of equipment, the installation, and the training. Okay, these were given to us or would be given in a question. If we add them all up, we get the total first year costs. Okay. Then next we have to calculate the reoccurring costs over the next 5 years. Okay, maintenance, cost of forms, both had a cost per year for each piece of equipment. We take that cost per year, multiply it by the 5 years that we're going to have it, and it will give us the total cost or the total reoccurring cost for each of those items over the next 5 years. Okay, we would then subtract the residual value because that's a benefit. That's something that we're getting from selling it. So we subtract that here. And then we add it all together to get the total reoccurring costs over the 5 years. If we take our total first year costs and our reoccurring costs, they equal total overall costs. In this particular case, we should be picking and purchasing equipment B because it has the cheapest or lowest overall cost. Okay. Again, in this particular example, we are assuming that both pieces of equipment will suit our needs. Okay. For example, 2 walk-in freezers, we would hope, would freeze our products, right? And are of the same size. Okay. There is another alternative method to doing what we just did, and it's called the depreciation method, where we calculate the depreciation cost as a reoccurring cost over the next 5 years, and then don't consider the upfront purchase as relevant because technically it's sunk, okay? Because we can't get that back. Both methods will yield the exact same result. In fact, the depreciation essentially, how would I say, replaces the initial cost, because if we take depreciation, we calculate it straight line over 5 years, less the residual value, it's going to equal the initial cost. So you can do it both ways. We're going to practice both ways on Thursday, but they yield the exact same result. Apologies off the get-go. This is not supposed to say total. This is supposed to say fixed. There we go. So should we sell below fixed costs? Okay. So this basically means not generate enough income to cover your fixed costs. Now, obviously, this is, in most industries, this is would be seen as a very bad decision, selling below your fixed costs, because if your contribution or your income, your operating income is less than your fixed costs, you're going to have a loss or a negative profit, okay? And this is very true in many contexts. However, in our industry, it can be argued a little bit, okay? So our industry is a little bit different, where in some cases it could be financially better to sell below fixed costs, okay? For an example, you own a catering company. Your variable costs are massive, 60% of your sales, and your total fixed costs are 146,000 per year. Okay. You've been approached by a small event that has asked for a $10 per person price for 60 people. Okay. Excuse me. If we understand that one event happens over one day in a year, then we can calculate the fixed costs per day by taking 146,000 and then dividing it by 365 days, and we get a fixed cost of 400. Okay. Let's say our sales are going to be. Our sales are going to be $60 multiplied by 60 people multiplied by $10, and we get 600. Okay. Our variable costs, which are 60% of our sales, are going to be 60%, 0.6 multiplied by 600. 600, and we get 360. Okay, so 600 minus, which is our sales, minus 600 minus $360, which is our variable costs, gives us $240 left over. Okay, which does not cover our $400 of daily fixed costs, right? So we'd be doing this function at a loss, right? However, if there's something, if we understand something else, maybe it could change the way we're looking at this decision, which I'm going to show you on the next slide. Okay, so here's that example broken down a little bit. Again, in the first table up here, we have the P&L, or the profit and loss for the catering, like if we were to do the event. Again, our sales are 600, variable costs are 60% or $360, which gives us a contribution margin or gross profit of $240. We have $400 fixed costs per day, which gives us a loss for the particular event. Okay, this isn't even including taxes, so we're losing $160 doing this event. Okay. However, if we compare our P&L without the catering, okay, we still have so we've got no sales, no variable costs, of course, because we have no sales. Our contribution margin is 0. Okay, so sales minus the variable cost is 0. We still have the fixed cost per day. Because there's no sales to absorb that $400 a day, our operating income is actually lower when compared to an alternative of doing the catering gig. Okay, so in this case, if you had no other business lined up for the day, you should sell below fixed costs because it is a financially more responsible decision to make. Okay, it is still taking a chunk out of your yearly fixed costs. Okay. However, if you had another prospective customer who would create a greater contribution margin, okay, then you would take that job instead. Okay, but again, faced with 0 business, you would take this particular job and sell below fixed costs. In a very similar manner, we can answer questions as well as, like if, for resorts and, golf courses and stuff like that, or maybe not golf courses because they actually do close in the off season. You can decide whether or understand this impact on the question, should we close during the off season, right? So here's our P&L for running for 12 months, staying open. You'll notice that for 2 months of the year, we'll call this November and December, we're losing $9 grand, okay? Which is not good, don't get me wrong. If we closed and we stayed closed during the off season with no sales, we still incur those fixed costs because they don't change. It's rent, right? We still got to pay rent. So we actually lose more, okay? And as a result, the staying open, okay, right here, this is the total income for the 12 months, is cheaper or is more than closing for the 2 months. It's also being closed, a restaurant being closed, and I heard this from a coworker I used to work with. He's a regional operations manager for. He was a regional operations manager for Recipes Limited. He's now, I believe, the director of operations for Texas Lone Star. I could be wrong, but I think it's Texas Lone Star. The financial cost from being closed for a restaurant being closed is absolutely huge, and that's exactly what you're seeing here, right? By doing nothing, okay, we're actually losing $3,000 more between these two scenarios. Okay, so try never to close your doors. Obviously, we have to close for a little bit, right? Go home and get some sleep. But I mean, closing your restaurant, you're limiting your ability to cover your fixed costs and be profitable. Okay, in both examples here, they're both profitable examples, right? But one is more profitable, and that is always the one where the restaurant decides not to close. All right, just a bit of a debrief here from the previous 2 examples, which were largely about what we call contribution margin, okay? Contribution margin is a little bit of a relationship between your sales and your variable cost, but by definition, your contribution margin is the amount of money that goes towards covering your fixed costs and providing you a profit, okay? How we calculate that is our sales minus our variable costs. Okay, and the rule with your contribution margin is that you should never stop doing something or discontinue something if if or doing something has a positive contribution. Okay, fixed costs must always be covered to give us a profit. Variable costs are depending on sales. So if we have a contribution margin, we're contributing towards those fixed costs and also providing a profit. And that's what we want to make is profit. Okay, without a positive contribution, so having a negative or a zero contribution, you are bearing the full load of your fixed costs. Okay, and possibly creating a loss for your business. So again, when you're looking to make decisions about whether you should stop doing something, so not being open during the off season, or what was the previous example? I honestly forget now. I apologize. But the idea is that both had positive contribution margins, and thus we shouldn't stop doing them. Closing on the off season anyway. Understanding our variable and fixed costs is extremely important because these two costs, when combined together, make up 100% of our costs. And we need to understand how that structure, the difference between the levels of variable and fixed costs, is going to have on several financial outcomes. Okay, the dynamic between our variable and fixed costs have implications into several decisions that we could make. For example, which decision to buy, how our business is going to perform in different sales contexts. Whether or not to buy a fixed or variable lease, so rent. So it has implications on, how well we perform financially based on whether we choose a fixed or variable rent. Typically it's fixed, but we do in some cases have some options where we can get a variable lease. So it's based on a percentage of our sales. And we're going to start giving some equations. You're going to see these equations over again throughout the rest of the presentation because our variable and fixed costs are inputs, if you will, into several things. For example, break-even sales. Okay, that our break-even sales is the sales level at which we're covering all of our variable costs, our fixed costs, but making zero profit. So we're not making any money, but we're also not losing any money. And how we calculate that is our total fixed costs divided by our contribution rate. From the previous slide, our contribution rate is actually our contribution margin, which is our sales minus our variable costs, as a percentage of sales. Okay. We can also calculate it by taking 1 minus our variable cost percentage, which is our variable cost divided by sales. But more commonly, sorry, I'm just going to write this in. More commonly, our contribution rate, or CR, is equal to our contribution margin divided by our sales. Okay, our contribution rate, our contribution rate is basically our contribution margin as a percentage of sales. So it's the proportion of our sales that goes towards covering our fixed costs and providing for a profit. And I'm going to show you how some of this can be used in the following slides. So here's just a quick comparison of two businesses, and what we're going to be looking at here is the degree to which their variable costs are higher than their fixed as a percentage. Okay, which is what we're really looking at here is operational leverage. Okay, this is very important, so try and write this one down. Our operational leverage is the degree to which a business has higher fixed costs, okay, in comparison to variable costs. Okay, so if we're looking at the table here, we've got two businesses. We've got business restaurant A, okay, we got restaurant B. If we look at the percentages here, we can see that company A has their variable costs are 50% of sales, where their fixed costs are 40. Okay, so in this case, their variable costs are higher in proportion than fixed. Okay, on the other hand, restaurant B has a 30% variable cost and 60% fixed costs. So the fixed costs are higher. If you look at the bottom here, you'll notice that the profit margin or the net income as a percentage of sales are both 100 grand. Okay, so both of these businesses at this particular sales level, they both are making the same net income. So they're both performing the same way. Okay, but they have different cost structures. Based on this comparison and the percentages, you would show, or you should be able to identify, that restaurant B here is highly operationally leveraged, which means it has higher fixed costs in comparison to variable cost. Okay, this starts to bring into the notion or the concept of cost structure. Okay, so this is the breakup between your variable and fixed costs, and this breakup between the two costs has implications into financial performance given different sales contexts. So these two businesses here, while they're both making the same amount of net income, okay, at this particular sales level, which I believe is $1 million, okay, so they're both selling $1 million and they're making 100 grand at the end of the day. In different sales scenarios, these restaurants perform very different financially based on the fact that restaurant B has high operational leverage and restaurant A has low operational leverage. Okay, and we'll define cost structure in the next slide. So cost structure. Cost structure is generally defined as the degree to which costs are either predominantly variable or fixed for a particular business. Okay, as we had mentioned before, high operational leverage versus low operational leverage performs differently in different sales scenarios. Okay, and operational leverage is the degree to which a business's fixed costs are higher than the variable. To understand the implications of cost structure and operational leverage, we can conduct a sensitivity analysis to show how each business financially performs under different sales contexts, so either increases or decreases in sales. I'm not sure if you're familiar with what a sensitivity analysis is. It's just it's showing different financial results in different contexts. So, 10% increase in sales, 10% decrease in sales, and you analyze the results. Okay, so it's how sensitive your profit is in different sales scenarios, or in different scenarios very generally. Okay, so the next slide we're going to look at a sensitivity analysis to show you which business that we had just shown examples of, A or B, performs better and performs worse. So here's just a really quick sensitivity analysis of the two businesses that we gave example of. You recall from the previous example that at $1 million in sales, they both had a net income of 100 grand. Okay, but they had different cost structures. Okay, so we want to know how these two businesses differ in performance in different sales contexts, so increases or decreases in sales. Okay, so the first table I have here, okay, is a comparison of the two businesses with a 10% increase in sales. So we've increased sales by 10%, and we want to look at how the net income has been affected. Okay, so obviously both have increased from over 100 grand, but if you look at the percentage, the business that's performing better here is the one with operational leverage, or high operational leverage. Okay, that's because their fixed costs are a higher proportion of their overall cost structure. Okay, whereas compared to restaurant A, who has higher variable costs, is not performing as well as restaurant B. So in times of sales increases, businesses with a cost structure that is highly operationally leveraged, or has higher fixed costs in comparison to variable, these businesses tend to outperform businesses with higher variable costs. On the other hand, we have another table down here with another sales scenario. This is a comparison of the two businesses with a 10% decrease in sales. Okay, if you look down to the what is it called here? The net income, you'll notice that restaurant B now has a 3% profit margin and restaurant A has a 6%. So in this case, because restaurant A has low operational leverage or higher variable costs in their cost structure, they're actually outperforming restaurant B because restaurant B has higher fixed costs. Okay, so in a scenario where sales are decreasing, Restaurants that have a cost structure that are that's predominantly variable. So in this case, restaurant A has 50% of their costs coming from variable costs. Those businesses that are low operational leverage tend to outperform businesses that are highly operationally leveraged in scenarios where sales are decreasing. Okay. Now, immediately, two implications kind of pop into my mind. One is, think about which business would you rather buy? Okay, restaurant A or restaurant B? Okay, surely what we think of, if we understand or think about what's going to happen in the future, we can kind of make a decision, right? Both are profitable. Both of them have different cost structures. So if we understand what sales are going to be like in the future, okay, so are they going to increase or are they going to decrease? We can begin to decide, like which company would I rather own here, or what cost structure would I give my business? You know what I mean? Restaurants are particularly volatile, right? So if you're in industry, you know that on any particular day of the week, our sales are going up and down, up and down, up and down, based on a whole bunch of things, not limited to the weather, events that are going on in town, things like that. So, which would you rather have? From my experience, most restaurants, if not all restaurants, tend to have higher variable costs in their cost structure. This is because they tend to lose less money or outperform other businesses in times of sales decreases. Okay, so it's less risky, but also because of the products we offer, and the fact that most of our labor is wages, so variable. But it also has implications on another thing called break even, which we've already talked about. As a general refresher, the break even point for any business is the point at which their sales are covering their variable costs, their fixed costs, but no profit. Okay, so I'm just going to write that here. So break even is when sales is enough to cover your variable costs, your fixed costs, but profit at your break-even level of sales equals 0. So you're not making any money, but you're not losing any money either. And cost structure has implications onto what your break-even level is. And I'll show you that in the next slide. Okay, so here's the two restaurants again, restaurant A and restaurant B. We're going to show here the implications of the cost structure on break-even points for the two restaurants. Okay, so restaurant A has low operational leverage, meaning their fixed costs their variable costs are more as a percentage than their fixed costs, and restaurant B has higher fixed costs than variable costs, okay, which is highly operationally leveraged. Okay, if we calculate the contribution rate, restaurant B has a higher contribution rate because they have lower variable costs when compared to restaurant A, because restaurant A has higher variable costs and thus a smaller contribution rate. If we take the fixed costs and we then divide it, okay, so we're dividing it here. So 400,000 divided by 0.5 or 50%, our break-even level in sales is 800,000. That means we only have to sell $800,000 worth of sales. This could be $800,000 a year, or it could be, we'll call it a year. Then their profit equals 0, but at least they're covering their costs, right? This is that threshold that you're aiming for to be profitable. Okay, if you sell $1 more, then if you sell $801, so $1 more than the break-even point, you're making money. Okay. On the other hand, we have restaurant B with a contribution rate of 70%, which again is your contribution margin as a percentage of sales. If we take their fixed costs divided by 70%, okay, we get 857,000. So 57,000 more than restaurant A. Okay, so the benefit here is that restaurant A has higher variable costs, okay, whereby outperforms restaurant B in sales decreases, and also has the lower of the two break-even points. So it's a lot less risky, okay. That said, restaurant B outperforms restaurant A in sales increases, Okay, and if that's what we're anticipating in the future for our restaurant, then the higher break even point might not be as much of a concern. But again, restaurants are very volatile sales situations, so um, typically we like to look for and create in restaurants a lower break even point in sales, and we can achieve that through a highly variable cost structure. Here's a general recap of what I had just said. So businesses with high operational leverage outperform companies with higher variable costs when sales are increasing, and it's the opposite for low operational leverage. Okay, and a low operational leverage businesses tend to have a lower break-even point in sales volume. So what do you like? Again, what do you choose in terms of your own um, cost structure? It really depends on what you expect for the future. So if you were to look at your sales indexes, your trends, and your growth rates for your sales over time, and you find that they are consistently increasing, then it may be favorable to have, or maybe better to have, a highly operational leveraged business, because again, these kinds of business outperform low operational leverage businesses in sales times of sales increasing. But if you want to be cautious and less risky and have a lower break-even point, then you would go with the cost structure that is low operational leverage. Okay. Um, then again, there's some changes that you can make to your cost structure within a restaurant. But again, restaurants and most food service businesses, just by the nature of what they do and what they sell and who they employ, typically have low operational or have higher variable costs in their cost structure, right? Based on our food cost, our beverage cost, the majority of our labor. So a lot of this is kind of chosen for you. However, there are some things that you can do. For example, using a fixed lease or a fixed rent, which we're going to talk about in the next slide, but also having higher salaries, using more salaries than wages, right? Because that'll turn some of your variable labor into a fixed labor component, because salaries do not increase or decrease with sales volume. Okay, if you're a manager or have been in a management role in food service, it doesn't matter how long you work, you're getting paid the exact same amount, which is why when I was in industry, it wasn't uncommon for me to be working 10 hours a day, and that was almost expected, which was kind of bad. But anyway, there are some things that you can do to change the level to which you're more highly operational leverage, but the opportunities are limited. But like I had said, you do in some cases have the choice between a variable and a fixed lease, and I'm going to show you how to choose between the two in the next slide. So in some cases, we have the option to choose between a fixed or variable lease. Okay, so all businesses, if you don't own the building that you're operating in, you have to have a lease, so you're going to pay rent. Okay, some cases you may have that option whether you're going to pay a fixed rent, so it's not going to change, or variable. Okay, the variable lease means that the amount of rent that you pay is dependent on your sales level, right? This is normally calculated using a percentage, right? So your variable lease might be 25% of your sales, and that's how it's calculated, is multiplying it by sales. But to make that, this is a pretty big decision to make, right? This is a decision that is turning a cost either fixed or variable, right? And the degree to which your sales are increasing or decreasing based on your operational leverage, this can have some serious effects on your profitability, right? So we have to make a decision as to whether we want a fixed or variable lease, and how we do that is through, it's called the point of indifference. And this is calculated, or sorry, before I say how it's calculated, the point of indifference is the point in sales in which you don't care whether you have a fixed or variable lease. Okay. How we calculate this point of indifference, or point in sales where we don't care, is we take our fixed cost lease and then divide it by the variable cost lease. Okay. At this point in sales, you as a business owner would be indifferent. You wouldn't care whether it's fixed or variable. However, if sales are anticipated to be above the point of indifference, then a fixed cost lease is preferred to variable. Okay, and vice versa. So if you expect your sales to be below that point of indifference, you would pick a variable lease. And I'll show you the implications of this in the next slide. Okay, so here's an example of you deciding whether to have a fixed or variable lease. Okay, let's say you're deciding between either a $6,000 a month lease or a variable lease that is 20% of your total sales. Let's say that you're expected to generate $25,000 of sales in a month. What would you choose? Okay, well, we calculate our point of indifference. Okay, again, this is the point in sales where we don't care whether it's either a variable or fixed lease. If we take $6,000, which is our fixed lease per month, and divide it by, we're going to call this 25, my bad. Divide it by our variable lease, or 0.25, 25%, we get 24,000. Okay, so at $24,000 a month, we don't care, in sales anyway, we don't care if it's a variable or fixed lease. However, we anticipate our sales per month to be at least 25,000. Because 25,000 is bigger or greater than our point of indifference, we should be choosing a fixed lease. Okay, this will make you more. This will increase your fixed cost proportion of your cost structure. Again, because we expect that our sales are going to be greater than our point of indifference. So at this point, I think you're starting to see some of the importance of truly understanding the differences and the proportions of our variable and fixed costs. In some cases, with ours, within food service, our variable costs are a weighted average of our variable cost per guest is a weighted average between the labor that's needed to serve them, the food, and the beverage, right? So we have to understand exactly the difference between the variable cost per unit and our fixed costs. We can do this, or begin to understand what those numbers are, by separating our total costs into their variable and fixed components. We can also do this with semi-variable costs, to understand the difference between the variable and the fixed component. Furthermore, if we're going to do a CVP analysis, which we're going to do next in the second half of this video, if we don't know our variable costs as compared to our fixed costs, we can't complete the we can't complete the basic CVP equation, and if we can't do that accurately, we can't do we can't calculate our contribution margin. And thus, as a result, we can't calculate our contribution rate. And even our break even. But as I said before, we can also we also want to separate our semi-variable costs, which again is a cost that has a fixed and variable component, into the two components. Okay, so now I'm going to show you the three methods of separating either your total costs or semi-variable costs into their variable and fixed components for the purposes of a CVP analysis, or just understanding the difference between, let's say, your variable and your fixed labor. That would be an example of a semi-variable cost. So as I stated, there's three methods for separating your total or semi-variable costs. They can be all three of these methods can be applied to both types of costs. The first method is your high-low method, where you compare high figures to low figures, do some division, and it'll give you an average of what your variable cost would be. And thus, if you know what your variable cost is, you subtract your variable cost from the total cost, and it'll give you the fixed component. On the other hand, we have a multi-point graph method, which is essentially a scatter plot that we plot using data and create a trend line and extend it to the y-axis on the graph, or the scatter plot, and that'll tell us the fixed component of either our total cost or our semi-variable costs. We have regression. So we can perform a regression analysis using a regression equation to identify the fixed component of our total cost or semi-variable costs, and then performing a bit of algebra, we can calculate the variable component. You really only need to use one of these methods, but as you'll see, some of them are more accurate than others. But ultimately, whichever one you decide should be based on the data set size that you're using. Okay, for example, regression is probably the most accurate. Okay, next would probably be the high-low method, and then lastly the multi-point graph method. But that said, it depends on the data set that we have, right? So regression analysis usually depends on high or large data sets. Okay, we might not always have that. Okay, in which case we can use the multi-point graph. Okay, if we have very little data, or the high-low method if we have a medium-sized data set, which I'll show you in a second. Okay, so first we're going to talk about the high-low method, and the context that we're going to employ this method is within semi-variable cost of total cost, where we try to identify the variable component to our total labor. Okay, and I'm going to show you an example, but in the example we use 3 steps to calculate our variable cost per unit or guest. And it uses the dollar change of the highest and lowest values to calculate the variable cost per unit. Okay, so the first step in the process is find the highest and lowest values in the data set. Okay, so you got to look at your data set. You can sort it from highest to lowest, and that'll make an easy, an easy find. Okay, you then find the difference between the 2 values by subtracting them. Okay, so difference, I spelled that wrong. And then you apply the following formula. Okay, the average dollar cost per guest, in this case, average labor, is equal to the dollar change in cost divided by the dollar change in guests or units. Okay, so 3 steps. They're fairly straightforward, and it's best shown by an example, which is what I'm going to show you on the next slide. Okay, so here's an example of the method that we're going to be using. We're going to do this on our Thursday seminar, but just as a general, for a general understanding of how this method works. Okay, so we've got months of the year. Okay, we've got the guests served during each month. Okay, and then we've got the wage cost. So this is total wages, total labor for each month at that amount of guests served. Okay, so again, first step is we look through our data set and we find the highest and lowest values. Okay, these two, one of the assumptions we're making here is that these 2 variables here, guests served and wage cost, are linear to some degree. So when one increases, the other one increases as well. So you find the highest and lowest values. For example, I think 2100 right here are the highest values. Okay, and the lowest values, I believe, is 500 right here. Okay, so that's our high and low values. We then plug those in. So high right here, we've got the values. Okay, we're just putting them in. We've got the low values. Okay, so 500 and 14,400. We do the subtraction vertically to get the difference between the 2. Okay, and then we take the cost and divide it by the amount of guests served, and we get an average variable labor cost per guest of $7.50. Okay, so if we want to separate the wage cost or the total labor into the fixed and variable component, because again this is a semi-variable cost. Okay, we multiply the guests served by the average, by the variable labor cost per guest, and we get the variable component. Okay, to find the fixed component, we take the total cost. Okay, so in this case it's 14,400, subtract the variable component, and it gives us the fixed component. Okay, you do this all the way down, and for each month you have successfully separated the semi-variable cost, okay, into its variable and fixed component. You could also do this with total costs to get your average variable cost per guest and the fixed costs overall. Okay, and in doing that, we can start to begin to do a CVP analysis, which we'll do later on. In the next slide, I believe I'm going to be going over the multi-point graph method. Okay, so here's where we'll go over the multi-point graph method, which is essentially a scatter plot of the information or the data that we were just looking at. So the previous data, we had 12 months worth of guest counts and wage information, or total labor. So total labor. Okay, and we create a scatter plot based on that information. Okay, and if we understand that, again, both we assume have a linear relationship, okay, we can find the fixed cost of our total labor by extending a trend line that connects with the y-axis on the scatter plot. The value of the y-intercept, or where the line connects to the y-axis, is the value of the fixed portion of our labor. This is because that line, or the trend line, it's a line, and the mathematical equation for the line is y equals mx plus b. What this means is our total labor is a function of our variable labor plus our fixed, right? If we do some rearranging and we put in 0 here for x, so x equals 0, that means that we have 0 variable cost, and whatever is left over must be our fixed cost. So if we put that in, okay, so x now equals 0, where this mx is now equal to 0, because if you multiply anything by 0, you get 0. And what's left over is we get y equals b. Okay, so what that means is where the line connects to the y-axis at 0, okay, because that would be the corresponding x value on the scatter plot. Whatever y is, the value of y, or the y-intercept, is equal to b, which is the value of the fixed portion. Okay, if that was hard to follow, don't worry about it too much. I've got a picture or an example on the next slide, and we're also going to do this in our seminar together so that you get some practice doing it. All right, so here's that example. We have a scatter plot using the multi-point graph method. Okay, so we've plotted right here on the x-axis. This is guests. Okay, and on the y-axis, which is right here, this is total labor or total wages. Okay, and this is the x-axis. I'm just going to label some of this stuff. So x, y. Okay, so we've plotted the dots. Okay, these are our data set. Okay, so we've done that, and we've added a trend line, and I'll show you how to do that once we get to our seminar. We've added the trend line, and we've extended the trend line to the y-axis. Where it connects on the y-axis is at 1,000. Okay, so 1,000 is our fixed cost, or sorry, our fixed component of our labor cost, or our wages. Okay, again, we can do this with total cost to understand the difference between the average variable cost per guest, and our fixed costs. And even on Excel, you can hit an option that shows or pops up the equation, the y equals mx plus b, for this line. And if you do that, it shows your b is equal to 10,000, which is our fixed component, but it also gives you the variable component as well. Okay, so 7.5. So that's an average of $7.50 per guest served. Sorry, let me say that again. That is $7.50 in variable wages per guest served. So this is our variable component, variable cost per guest, and this is our fixed cost. Okay, and y in this case equals our total wages. Okay, while this method is actually pretty straightforward, and the logic is pretty sound, in this case the data is pretty spectacular because I created it. However, in most cases, the data is not going to be nearly as linear as you want it. For example, the data here that I'm showing you is perfectly linear. However, you'll see that in industry, even if your sales go down or your guest counts go down, your total labor doesn't necessarily go down as quickly. So it's not quite as linear as we would like it. So while you can still do this, what's going to happen is if you were to use real raw data, okay, you're only going to get a guesstimate of what the fixed cost portion would be. Okay, that's because of the lack of a 100% linear relationship in the data, but also because yeah, that's pretty much why actually. um, Another piece of advice I'd give you if you were to use this information, this particular method, is do it on Excel, which is what we're going to do in seminar. Because if you were to do this by hand, that trend line is pretty much all subjective, right? So you're putting that trend line wherever you think that trend line should go, and is really the result of this analysis is dependent on your ability to draw a straight line with or without a ruler. For example, me, even with a ruler, it's not going to be that straight, which is really bad. But if I was doing this and I was using this method, I would be doing it on Excel because it's a lot more precise. Okay, so now that we've showed you the high-low method, the multi-point graph method, which is a scatter plot. Okay, now we're going to show you regression analysis. Okay, I'm going to speak to the idea that it's going to be a lot more accurate. Okay, it's similar in some ways to the multi-point graph method in the sense that regression analysis looks at an equation that that works 100% of the time across a data set, and it finds a relationship with that equation, very similar to the multi-point graph method. For example, we found that y equals 7.5x plus 10,000, but in data that is correlated semi-linear, regression is going to be a much better indication of what your fixed and variable components are. And I'll talk about that more on the next slide. All right, so regression analysis. This is a statistical modeling method or analysis method that looks for a relationship between a dependent and an independent variable in a data set. Okay, there are some assumptions that need to be met when using regression analysis, and in this case we're just using simple regression, although there are other methods as multiple regression. You even get into the multivariate statistic version. Okay, one of the assumptions that we need to make here is that there is a relationship between our dependent and independent variable, but also that they are linear. Okay, so there is a linear relationship. Okay, and what the regression analysis does is find that that relationship and boil it down into one consistent relationship that speaks to the entire data set. Okay, and in doing that, we can find the fixed component of our variable cost, a fixed component of either our total cost or semi-variable cost, and by an extension, doing a little bit of math, we can find the variable component. Okay, you can use Excel for regression analysis, but I think it's much easier just to use an equation. Okay, because there's one equation, whereas if you use the regression analysis in Excel, you have to get into p-values, t-values, significance, and stuff like that, which I don't think we're quite there yet. So the equation that I'm going to show you is much simpler in application, and I show you that on the next slide. So to conduct the regression analysis, okay, we have to do some serious calculations. Now this is a pretty scary looking formula, okay, but we're going to simplify it a little bit for you. Our fixed costs, okay, are equal to the sum of the y values, multiplied by the sum of x squared values, minus the sum of the x values, multiplied by the sum of the xy values, so x multiplied by y, all divided by n, which is the number of months or observations in the data set, multiplied by the sum of x squared, okay, minus the sum of x squared. Okay, and if we put that into a calculator, we should get the fixed cost portion of our wages or our total costs, okay, depending on the context that you're using. Now, obviously, putting this into a calculator is going to be a gong show. If you've got a large data set, you've got to use Excel for this because, as we know, if you put a wrong number into a calculator, you're going to get the wrong number as an output, right? So I'm going to show you an easy way using the data set and a few other columns to calculate this in a bit of an easier way. So what we're going to do is we're going to create columns or rows for the sum of y, the sum of x squared, the sum of x, the sum of xy, and so on and so forth. And then using Excel, input this equation into a cell using the data that we just created, and we will arrive at our fixed costs. Okay, please look to the next slide for an example of this. So here are two examples of a completed regression analysis that I've done and that we're going to do on Thursday. On the right-hand side here, I'm just going to get my pen up. On the right-hand side here, okay, we've got the long way of doing the regression analysis. Now, this part over here on the right-hand side is only a partial regression analysis where we use a regression equation to solve for the fixed portion of our wages. Using in the previous slide, I gave you an equation. That is the equation where you're solving for B, okay, which in the regression equation, the linear regression is equal to y equals mx plus b. Okay, so it's the slope of the line, okay, except that m is no longer referenced as m, it's a. Okay, so it's not a big deal, it's just it's a dummy variable that we put in there. Okay, so in our little chart here, we have the original information. So here's our data set, okay, and I've created 2 additional columns and an additional row to get a few pieces of information needed to complete that equation. Down here, this is the total of all the x's, so this is the sum of x. Okay, over here, very similar, is just the sum of y, which we need for the equation. And then the last 2 columns gives us the sum of xy and the sum of x squared. Okay. Now these are the inputs that we use for the equation. The only one that we're missing in this case, the only variable that we're missing is n. Okay, but in this case, n is the number of observations, and in this case, we are observing 12 months. Okay, January through December, so n equals 12. When we put all these values in to the equation, we get a monthly fixed wage or a fixed labor cost of $10,000, which is what we saw in the previous multi-point graph method. Okay, that's because again I've turned our total labor into an expression of y, or total labor equals 7.5 plus 10,000. Okay, again in reality it's less perfect, obviously, but if we use regression, we can, and what this is called least squares simple regression. So what that is all the data points, while they might not fit perfectly on a line, well, the least squares bring them in as close as possible to creating a straight linear line, and that's where we get or can calculate our monthly fixed labor or total fixed costs. Okay, it depends on the context. In this context, we're using labor. On the left-hand side here, in Excel, there's a data analytics add-in. Okay, I can show you how to add that in on Thursday, but it literally takes all the calculation work out of you doing this, right? So what I'm going to show you is how to use the data set, okay, which is right here. Okay, and with a few clicks, it's going to give you this. Okay, so there's a whole bunch of data here that you really don't need. Okay, but what you want to look at down here is the coefficients for the variables that we're looking at. So the intercept again, okay, that's b, that's the fixed portion, and the x variable is the variable portion, and you can see that the variable portion of our wages is 7.5 per guest. Or $7.50 per guest, and the fixed portion is again 10,000. Where if we complete the equation, y would be our total wages is a function of 7.5 multiplied by the number of guests, okay, plus 10,000. So that's our linear line. Okay. If that was confusing, I hope that I can clear up some confusion on Thursday through our seminar. This doesn't have to be terribly complicated. If you use either the equation or the data analytics pack with Excel, you're going to arrive at pretty much the same answer. Okay, it's a matter of just inputting variables for the equation, or using the data pack to arrive at these answers. And yeah, it's really simple. I'm not expecting you to know or be able to define regression analysis for me. Although if you wanted to know, it finds the linear relationship between two variables, and in this case, it was guests served and our total wages. So there are limitations to the methods that I've gone over. For example, the multi-point graph method is kind of limited to your ability to draw a straight line, and it doesn't necessarily estimate the perfect linear relationship in the data set. It's just calculated by a straight trend line, okay? And many data points may exist outside of that trend line, whereby making it not very accurate, okay? The high-low method is good, and it's a rough estimate. However, it's limited to really only 2 periods worth of information in a very volatile industry like the restaurants. So this method here is limited by not being terribly accurate. As a result, regression is typically viewed as much more accurate, although in some cases you need a rather large data pool. For example, in ours we had 12 observations. That's kind of on the medium size range. Okay, I would say that if you had if your data set was really low, like 2 periods or 4, I would use the high-low method. Okay, if you've got a relatively medium size data pool like ours did, and you can tell that there is a serious linear relationship within the scatter point, then a multi-point graph could be used. Okay, but if your data set is medium to large, regression analysis is again more typically viewed as being more accurate among the 3 options. Okay, so if you've got a good data set, even if a clear linear relationship between the 2 variables is not clearly seen, regression analysis is still a good way to break up your semi-variable costs and your fixed costs from your total costs, because it uses the least square method to bring those data points into a common line. Okay, so in the previous example, we broke up a semi-variable cost into its variable and fixed components. Okay, we can also apply those 3 methods to breaking up total costs into its variable and fixed components. Okay, if we recall that our sales are equal to our variable cost plus our fixed cost plus our profit, which is the CVP equation, we need to know what the fixed and variable components are of our total costs to be able to complete a CVP analysis, which is what we're going to talk about next. So here's where we begin to talk about CVP analysis. Okay, CVP stands for cost volume profit. Okay, and by completing a CVP analysis, we're looking or studying the effects of changes in costs and volume and their effect on company profits. Right. So what happens to our profit if costs go up, or if costs go down, or if volume goes up or down. Right. It's a good tool to be using when looking at management decisions. Okay, so whether to increase prices, decrease variable costs, what's the effect on our profit going to be if sales decreases by 10%, things like that. And as a result, it's super important for budgeting and profit planning. Okay. Some of the key pieces of information we need to know in order to complete a CVP analysis is the unit selling prices of our products, or our average guest check in our cases, the variable costs per unit, and our total fixed costs, where we would understand these because we now know how to separate our total costs into fixed and variable components. The sales mix at which our products are being sold. Again, we sell many products in comparison to, say, like a manufacturing company that only manufactures one product, right? The sales mix is limited to one product. However, ours, we sell multiple products, and when we use a sales mix, or calculate our sales mix and calculate our sales based on that, we can arrive at our AGC, which is our average guest check. Okay, so that's on average what our guests are spending when they come into the restaurant. And then we can understand by completing a CVP analysis the level of business activity or volume needed to arrive at a particular point of profit, a particular level of profit, or even a break-even point, which again is the level in sales in which profit equals 0. So the remainder of this video and this PowerPoint is fairly hands-on. With there's going to be quite a few equations. I've shown a few of them to you already. I don't want to complicate it too much. Some of the things that we're going to be showing are break-even analysis, okay, or several versions of a break-even analysis given different contexts or different situations. And we're also going to be showing, using a break-even analysis, what kind of profit we can expect to get on a certain level of sales activity, or how much sales do we need to have in order to make a target profit or a target return for us when considering tax implications. So before we get into looking at doing those break-even analysis and things like that, we need to go over a few definitions and a few equations. Okay, our contribution margin, what I've kind of already told you about, is the is the amount of sales dollars that we have generated that go towards covering our fixed costs and contributing to a profit. Okay. Where am I going to write this? Okay, so if our sales are equal to our variable costs plus our fixed costs plus our profit, and our contribution margin is the amount of money that goes towards covering our fixed costs and our profit. If we rearrange this equation to solve for our fixed cost plus our profit, it becomes fixed costs plus our profit equals sales minus variable costs. Okay, if we understand that the amount of money going towards our fixed costs and our profit is our contribution margin, then our contribution margin is equal to our sales minus our variable costs. In this case, we are calculating the contribution margin per unit. So this is the specific dish's selling price minus its directly variable costs. So it's variable labor, it's food costs, things like that. And then this that gives you the contribution margin per unit. So every time you sell this product, there's a certain portion of the sales price that is going towards covering its fixed costs and our profit. Okay, so let's say we have this deck is a little dated because the examples we're working with here is a video store or a video manufacturing place. So let's say we had a particular dish. So let's not even put a context on this, or let's put a food service context on this. Let's say we had a dish, okay, obviously, and it's going to cost $500, okay? I know it's a bit extreme, but work with me here, okay? And then the variable costs associated with creating this dish are $300, okay? We take 500 minus 300, and we have $200 left over. That means, A, this dish's contribution margin per unit is $200, but also that every time we sell this dish, $200 goes towards covering our fixed costs and providing for a profit. Okay. While this example is the contribution margin per unit, we can also have total contribution margin, which again is very simply your total sales minus your total variable costs. All right, so here's where we introduce the contribution margin ratio or the contribution rate. Okay, two names for the same thing. I prefer to call it contribution rate because it's smaller and it's easier to say. Much like your contribution margin, you can calculate your contribution rate either per unit or total. Okay, in this particular slide, we're talking about our contribution rate per unit. And how we calculate that is taking our contribution margin per unit, dividing it by the selling price of our dishes or the product, and it'll give us the contribution margin ratio or rate. Okay. Otherwise, if you're looking for your contribution rate in total, it's calculated by taking your contribution margin. Okay. So your fixed cost plus your profit divided by your sales. Okay. In this case, we have a $200 contribution margin per unit divided by a $500 selling price, and we have a contribution rate or a contribution margin ratio of 40%. That means 40% of this product's price goes towards covering its fixed costs and its profit. Now, where we're going to start to use these things, the contribution margin and the contribution rate, is in our break-even analysis, which I show you in a few slides. Other than our break-even, uh, other than our break-even analysis, we can use our contribution rate or contribution margin ratio to understand how different increases in sales volume will affect our net income above break-even. Okay, so let's say we are at our break-even level. Okay, and so we're at a level of sales where we're not making any profit, right? So in this case, with no change, our break-even level in sales is $500, right? You'll notice that we have zero operating income, okay? If we were to have $100,000 worth of sales increase, okay, so if our sales were going to go to 500,000 to 600,000, we could easily know the effect on our net income, okay, by taking the increase, or 100,000, and multiplying it by our contribution rate or contribution ratio. Okay, so if we take 40%, which was our contribution rate, and then multiply it by the increase, or 100,000, okay, we get 40,000, which is what the increase in the profit would be. Okay, so you can quickly understand, using your contribution rate, the effect or the increases of, that's going to happen in your profit based on increases in sales. All right, so here's where we get into break-even analysis, okay? I'm going to try and keep this pretty simple. If I'm being honest with you, it's just a bunch of quick calculations you do. And yeah, so again, our break-even point, or the break-even analysis, is where we find the point in our sales where we are making zero profit. Okay, so profit equals zero. We're not making any money, but we're not losing any money either. Okay, this is the level of sales activity in which total revenues, or total sales, equal total costs, which are a combination of both fixed and variable. Okay, this point in your sales can be calculated in a few ways. Okay, we're not going to talk about the CVP graph because nobody uses that, and it's pretty much pointless when we have a mathematical equation and using our contribution margin. Okay, it's also important to note that our break-even analysis can be expressed in either dollar sales or in sales units. So that's the difference between, a dollar sales figure or the amount of guests that we need to serve, right? Sorry, phone was going off. Very basically, the mathematical equation that you could use, which we're not going to touch on very much, is the CVP equation, where your sales are equal to your variable costs plus your fixed costs plus your profit. Okay, if we know that break even is a point where P equals 0, then rearranging this equation and eliminating your P, your sales are equal to, or your break even sales are equal to your variable costs plus your fixed costs. So if you know those two items, the addition of your variable costs plus your fixed costs equals your break-even point in sales. Okay? The contribution margin method is what we're going to be using in the following slides, and it's very easy, very straightforward, and you don't need a lot of information to do it. Here's where we can use the contribution margin to calculate our break-even point in sales, but also in units. Okay, so let's assuming that we know what our fixed costs are, right? If we know what our fixed costs are, okay, because either we know based on an income statement and we've added up all of our fixed costs, or we know what our total costs are and we've separated the fixed and the variable components. If we take our fixed costs, divide it by our contribution margin per unit, it gives us our break-even point in units, or how many guests, in this case, we need to serve. Number of guests, okay? On the other hand, if we want to find the break-even point in sales, we again take our fixed costs, and instead of dividing it by our contribution margin per unit, we divide it by our contribution margin ratio, or contribution rate, okay, which is our contribution margin as a percentage of sales. If we do the math here, very quick math, it gives us our break-even point in dollars. So this is the dollar sales needed to break even. No matter which way, no matter which method you use, profit is always going to equal zero because we've covered our variable costs and all of our fixed costs, but only to the level of our fixed costs, which means profit equals zero. The first method here will again tell you the amount of guests you need to serve in order to hit that break-even point, which is useful to know on any given day, to be honest with you. And two, the second one here gives us the dollar sales. Okay, so the sales level. However, there's two additional things I want to talk about in this video. One is, it's useful to know your break-even point, but we don't just want to make zero profit. So we need to know or use break-even analysis to find out the amount of guests we have to serve to generate a certain level of sales in order to cover our variable cost, fixed costs, and make us a certain level of profit. Okay, and then after that, I bring up the notion of weighted average contribution, which is important for us because we don't sell one product. We sell many dishes on our menu. Okay, but just continue before we get to the two last things I want to talk about. Here's a quick example of using those contribution margin techniques in calculating our break-even. First, we're calculating our break-even in units. Okay, so if we have fixed cost of 200,000 and our contribution margin per unit is $200, which again is equal, your contribution margin is equal to your sales price minus your variable cost per unit. Okay, we do the math here and we get our break-even point in units. So this means we have to sell 10,000 units or products or dishes or whatever to cover our fixed costs but make zero profit. Again, break-even means profit equals zero always. Okay. On the other hand, if we wanted to know what, it's useful to know how many things we need to sell to break even, but what does that mean for sales, right? Like what sales level is required to make zero profit but cover our costs? In a similar fashion, we take our fixed costs, divide it by our contribution margin, our contribution rate per unit. Okay, so again, this was 40% as we calculated before. We do the math and our break-even point in sales, okay, so dollar value is 500,000. So now in the next two slides, we're going to be talking about using a break-even analysis to understand how many units you have to sell or the required sales level in order to generate or hit a certain target operating income before tax. Okay, in the next slide, we're going to talk about a net income after tax. Okay, so what we're really doing here is it's very similar to what we had just done in the previous slide, except that we're adding the target income or the target operating income that we want to achieve to our fixed costs. Okay, we often call this desired profit. Okay, so it's our fixed costs plus our desired profit divided by our contribution margin per unit, and that gives us the required sales in units in order to cover our fixed costs and make a certain amount of operating income. Okay, we do the exact same thing if we want to know how much sales we need to generate, like as a dollar value. So again, we're taking our fixed costs, we're adding the desired operating income, we're then dividing it by the contribution rate or ratio. And if we do the math quickly, again, you're adding the fixed cost to the target operating income. You do the quick division and you get $800,000 in sales. So what that means is if you sell 1,600 units or $800,000 worth of sales, you're covering your fixed cost of $200,000 and you are generating a target operating income of $120,000. But again, that's great, but what implications does this have on profit, right? Operating income is good, especially higher the better, but we still have to pay taxes on that operating income. And this particular analysis here doesn't take into consideration the effect of taxes on our net income, which is what we're going to talk about in the next slide. So as mentioned before, we it's good to know the break-even point at which we can make a certain target operating income. However, if we consider that we want to make profit and we want to really focus in on the profit after tax, then we can use the break-even analysis to find the point in sales or units sold that will yield a specific operating income after tax or profit. Okay, the equation we use here, that we have to add an equation to our fixed cost, and that equation is the target operating income after tax, which is AT. Okay, so in this case, we're trying to make our target operating income after tax or a profit as 120,000. We then divide that by 1 minus the tax rate. Okay, in this case, the tax rate is 40%. Okay, so we take the original fixed costs, and we're calculating in this particular calculation, we're calculating the required sales in units. Okay, so we take our fixed costs, we add 120,000 divided by 1 minus 0.4, or the tax rate, and then divide that by 200,000, and in this case we get, we divide that by a contribution margin per unit of 200, and we get a required sales in units of 2,000 units. At that level of sales, 2,000 units, we would cover our fixed costs of 200,000 and produce an after-tax income of 120,000. Okay, if we wanted to know the dollar sales level, we would do the exact same calculation, except we replace our contribution margin per unit with our contribution ratio or rate. Okay, we do the division, and we get a required sales level of $1 million. Okay, so we need to sell $1 million worth of sales in order to cover our fixed costs of 200,000 and produce an after-tax profit of 120,000, given a 40% tax rate, or 0.4 in this case. Excuse me. So those are the major break-even analysis that we can be applying to some managerial accounting. So that's breaking even where profit equals 0. That's doing a break-even analysis to calculate the required sales levels to earn a specific target operating income. And in this example, we did a break-even analysis to generate a after-tax, or to find the sales volume required to produce a specific after-tax income. So here's where we're gonna start to spin off into something new, and it's called the margin of safety. Any business's margin of safety is the difference between actual or expected sales and the break-even point. Okay, this can be expressed as a dollar value or as a ratio. Okay, but essentially your margin of safety is basically telling you that buffer in sales before you hit your break even. Okay, so you take your actual sales. In this case, we're calculating the margin of safety in dollars. So we're taking our actual sales, okay, of 750,000, or this could be expected or budgeted. Okay, once we subtract the break-even point in sales, it tells us that we have a $250,000 buffer or margin of safety where sales could decline and only hit our break-even point. So basically, we've got a $250,000 buffer or gap where sales can decrease to a point where we're going to make 0 profit. Okay, so it's almost like it's a level of risk, if you will, right? The higher the margin of safety, the less risky things are. The lower margin of safety in dollars, that would imply quite a bit of risk, right? What it means is that it's your business is very dependent upon sales. I mean, all businesses are, but even a small decrease in sales based on a small margin of safety could turn your business to become unprofitable. But as I had mentioned, we can also express our margin of safety as a ratio, which is what we do in the next slide. So here we go. This is this is the margin of safety ratio. It's very simply the margin of safety in dollars divided by the actual or expected sales. Okay. In this case, we're taking our margin of safety of 250,000. okay? And we're dividing it by the expected or actual sales of 750,000. When you do the division, you get a margin of safety ratio of 33%. So what this means, okay, and maybe this is more easy to use than the margin of safety in dollars, but what this means is that this business's sales can decrease or drop by 33% and not hit their and not fall into a loss, okay, where they're making no profit, okay. The higher the margin of safety ratio, the higher the margin of safety and the less risk your business is in generating a loss opposed to a profit. So here's where we begin to address the idea of sales mix in CVP analysis, but more specifically break even, right? Most companies, most restaurants or businesses within food service offer more than one product that is sold, right? As we saw in menu engineering, there is a menu mix percentage that is attributed to every dish on the menu, and that gives an indication of that particular product's popularity. Okay, if we understand the percentages or this menu mix percentage for each product and the contribution, okay, and that they have different contributions, I should say, then our contribution margin per unit cannot be one product's contribution margin over another. It has to be a weighted average. Okay, so when we're talking about contribution margin per unit in food service or in restaurants, it's actually a weighted average of all of the contributions based on the amount of by which each product sells. So in the next two slides, I'm going to show you how to calculate that weighted average contribution margin per unit, and I'm going to show you how to calculate a break even based on that weighted average. So what we do here, calculating the weighted average contribution, okay, we take each product's contribution margin per unit and then we multiply it by its percentage of sales, okay. Once we've done all that for each dish, we add them together and that should equal our weighted average contribution margin per unit, okay. We can then use this weighted average to calculate our break even in units by taking the fixed cost, all right, and dividing it by the weighted average contribution margin per unit. Okay, I'm going to show you what that looks like in the next slide. Okay, so we're going to do this in two steps. Okay, we're going to do a step one where we determine the weighted average contribution margin. Okay, and where we calculate the break-even point in units. Okay, while this example uses two products, DVD players and TVs, this process can be easily replaced with the dishes on a restaurant menu or on a catering menu or on, with a food service context. Okay, because the formula is the same, it's just the numbers that and the context that is different, really. Okay, so let's say we had DVD players which we sell for, should put my pen on here, that we sell for $200. And we've got TVs that we sell for $500. I want to buy a TV for $500. Geez. Let's say the menu mix percentage for DVD players is 75%, and the menu mix percentage for TVs is 25%. Okay, we multiply the contribution margin per unit, and sorry, that's what the 200 and the 500 is. It's the contribution, not the sales price. We multiply it by the menu mix percentage, and then we add them together, okay? And we get the weighted average contribution. In this case, it's $275,000. It's $275. Apologize, I've been saying thousands for the last 2 hours. Anyway, so these two items added together gives us our weighted average contribution margin per unit. Okay, and if we take our fixed costs, let's say our fixed cost was $275,000, and we divide it by the weighted average contribution margin per unit, we get our break-even point in sales, or sorry, in units. In this case, it's 1,000. That takes into consideration the sales mix of our different products, because again, in restaurants we sell more than one, and we don't sell them equally. Okay, so our average contribution margin should be a weighted average of all the products we sell based on each product's contribution margin per unit and the menu mix or sales mix percentage by which it sells. Okay, and again, the sales mix percentage is equal to the number of the products sold divided by total number of products sold. Okay, and doing that, you'll get the sales mix or the menu mix percentage for each of the products. Okay, you can easily retrieve this information from a menu engineering analysis. And yeah, okay. So I think that's all we have for today. In this video, we went over cost management and implications of costs and cost considerations with respect to various different decisions that we could make around cost structure, around contribution, around fixed and variable costs, and separating those things. We talked about the three methods of separating semi-variable and total costs into variable and fixed components. And we've talked about cost volume profit, or CVP, where we took a look at different kinds of break-even analysis that we could do. For example, we could do a straight break-even in units sold or in dollars, in sales dollars. We can now do it with a target operating income, or even a target profit or net income after tax. All right. And lastly, we showed you how to calculate weighted average contribution margin per unit and to use that in calculating your break even, because we know in our industry we sell more than one product and they don't sell equally. So we needed to calculate a weighted average to more accurately display our break even and units. Okay. So thank you for watching this video. We're going to be practicing all these things on our Thursday seminar. Okay, so see you then, and let me know if you have any questions through email.